Does your employer offer a health savings account and you may not know what it is or you're not taking advantage of it? Well, you are walking past the absolute best tax deal in America. So today, please listen up and I'll show you how to take advantage of this great opportunity. So most people either aren't signed up for HSA or they treat it like almost like a flexible spending account where what money goes in goes out and is expensed on healthcare expenses. That's a real big mistake. A health savings account can offer a long-term, tax-free growth opportunity that is second to none. It offers triple tax advantage. It is deducted from your income, so it's tax-free when it's earned. It grows tax-free, and when it's distributed, it's also tax-free. It's the only investment opportunity that offers all three of those tax advantages, and it's one that you cannot afford to not be taking advantage of. All right, so what is a health savings account? So it is a pre-tax savings account that is used for healthcare expenses. Those can be used either now or in the future at any time. And there is an opportunity after age 65, if you don't have any healthcare expenses, you can pull it out and it's basically treated as a traditional IRA. So don't worry about not being able to spend all these funds that you've socked away. There's still an opportunity to take those out. Now, here's a big difference from the FSA is an HSA is owned by you. So it is not a product of the employer. It is owned by you. And when you leave that employer, you get to take that HSA with you, including the entire balance. So that is yours and it is portable to your next job. So for a health savings account, there are eligibility criteria. Those eligibility criteria are relatively strict and it has to be a high deductible health plan. A lot of you military retirees out there, fortunately, you're not going to be eligible for this healthcare savings account because you are eligible for TRICARE. As well as any retirees that are on Medicare, that also makes you ineligible for an HSA. But if none of those apply to you and you are on a high deductible health plan, then please keep listening because this plan will save you a lot of money. So the minimum deductible that is required of these high deductible health plans for 2025, it was $1,650 per person and $3,300 per family. So your high deductible health plan can be higher than that, but it can't be lower than that. On the opposite side of the coin, the maximum out of pocket can be no higher than $8,300 for an individual and $16,600 for a family. And these numbers are 2025 numbers. The other thing is it can't provide any reimbursement for any non-preventative procedures prior to that deductible being expensed. And you can't be covered by any other high deductible health plan. So if you have a high deductible health plan at work, but you are a military retiree and have TRICARE, you can't sign up for the high deductible health plan and sign up for the HSA and still have TRICARE. It doesn't work that way. So you can't be eligible for any other plan. The other thing is you can't have a general purpose FSA. So those things like a general applicable savings account where you're using that for your deductible, those will make you ineligible for an HSA. However, you can have a limited FSA where it would pay for things like dental and vision, but won't pay for any medical expenses like going to see a doctor and your deductibles. So if you are eligible for a limited FSA, you may be able to have both. So the contribution limits for 2025 for a HSA is going to be $4,300 if you're on an individual high deductible health plan. But if you have children and you're on a family high deductible health plan, you'll be eligible for the $8,550. If you have a spouse and you're on a family plan, again, it's $8,550. But if you have a family high deductible health plan and your spouse has a family high deductible health plan, you are still only eligible for $8,550. So you can split it between you two of you. You can put it all in one, but you're still limited to that $8,550. It's not just double the individual. It is going to be capped at that $8,550. However, if you're both over age 55, you both can contribute the extra $1,000. But if you're over 55, only you can do it. And if your spouse is over 55, only they can do it. But if you both are, then you're both going to be able to contribute $1,000. So ultimately, you could be eligible for up to $10,550. And the extra benefit is those contributions can be made by your employer as well. So if you're eligible for those or a matching contribution, make sure that you're taking advantage of that. All right. So I talked earlier about the triple tax advantage. So, for an HSA, what is that triple tax advantage? Well, when you earn that money, it's tax free. So, it comes off of your income and is not taxed. And then it grows tax free. So, there's not going to be any taxes along the way, no capital gains along the way. It's all going to grow tax free. And then when you pull it out, as long as it is for an eligible healthcare expense, that's also going to be tax free. So it's a triple tax advantage. It is also the only account that is triple tax advantaged. All right, here's a big one is don't treat your HSA like a checking account where you're just writing checks out of that HSA on an annual basis and you're just basically replenishing that account every year. Treat it as an investment vehicle for long-term growth. Pay those current medical expenses out of pocket. I know sometimes that's hard, but figure out a way to do that where you're not tapping into the funds in that healthcare savings account. Let that healthcare savings account continue to grow tax free. But I want you to hold on to those receipts. And then use low cost index funds. A lot of people don't even know that they have an option to invest those funds in anything other than a cash account. So make sure you're logging into those healthcare savings account and make sure that you are electing something that is like a diverse long-term investment opportunity for you, like a low-cost index fund or anything that you feel would be appropriate to you. But please don't just leave it in cash for 30 years. The other thing is make sure that you're saving those receipts for later. You can use a receipt that you spent in 1993 and pull money out in 2023 using that receipt. Please scan in all those receipts, make backups of the files, and keep a hard copy of those receipts. So you'll have 3 different opportunities to make sure that you retain those receipts. And then later on in life, that's when you're going to go ahead and use those receipts to pull those funds out and use those for income later on in life. But you're going to let those funds continue to grow tax-free for 20, 30, 40 years. So what are the eligible expenses for an HSA? It's going to be anything like a deductible, a copay, a cost share, dental, vision, prescription drugs, over-the-counter drugs. They're all going to be eligible expenses. And then in retirement, even your Medicare premiums are going to be eligible. However, Medigap premiums will not be, but your Medicare premiums will. Also, long-term care premiums are also eligible expenses from an HSA. So keep that in mind. And then any out-of-pocket care expenses that we talked about previously. And see that IRS publication 502 for a complete list. And here's the kind of get out of jail free card. It's the age 65 rule. So kind of an odd number there in a lot of the tax code. It's either 59 and a half or 70 and a half or 75. This one's age 65. So a little bit different, but now withdrawals for qualified expenses are still going to be tax free. But after age 65, you can take a withdrawal for any reason and then it'll just be taxed as normal income. So think of that as it's basically just reverts to a traditional IRA because it is still tax-free when it earned. It grew tax-free, but now it's taxed on the way out. So your HSA, if you choose to use it this way, it just reverts into a traditional IRA. So it's still the worst case scenario is it's going to be as good as a traditional IRA. So keep that in mind. But if you do decide to take it out before age 65, on a non-qualified expense, it's a pretty big hit. It's a 20% penalty, plus you're going to pay those income taxes. All right, so a lot of you may be asking, what happens to my HSA upon my death? So it is a little bit tricky, and it's something that you want to be paying attention to. But if your beneficiary is your spouse, then that HSA just converts to their HSA. So it just transverses to the spouse, and no problems. Still get the full tax benefits of that HSA. However, if you're the surviving spouse or you elect to give it to a child instead, those are going to be non-spouse beneficiaries. And the problem here is that balance immediately is distributed and is taxed as income. There is no penalty. It just goes back to that traditional IRA, but it happens all in 1 year. So if you have a multi-$100,000 HSA and you pass away and it goes to your son or daughter, well, that's going to create a rather large tax bill. So be cautious of that and make sure that you don't have really large balances in that HSA as you get older. And if you don't have any beneficiary listed, it would go to your state, and then that would be all distributed in that final year that you passed away, and it would all be taxed to your estate. So why does an HSA matter for veterans? TRICARE does disqualify it from HSA eligibility. So I am sorry for retirees. I'm a retiree myself. I'm not eligible for an HSA. I wish I was. But veterans who use the VA, if they use it too often, they may be ineligible. But if you use it infrequently, you may still be eligible. So look into that if you are just using VA care. It's also a great opportunity if you separated from the service and now you're with an employer with a high deductible health plan. Well, now this one's for you. So if you are a veteran that is not a retiree and you are in a career where you have a high deductible health plan, please make sure you're taking full advantage of the HSA. So this is how you maximize the benefit of an HSA. So you need to contribute up to the limit every year. Then you're going to make sure that those funds are invested for long-term growth, not just sitting in cash. Then we're not going to expense anything out of those accounts, but we are going to keep all of the receipts that we accumulate along the way because they will be eligible even 30 years, 40 years down the line. We're going to keep those and we'll make sure that they're going to be backed up in multiple places. And then when we get to retirement, then we're going to start using the funds out of there for things like our Medicare premiums, healthcare, and long-term care expenses. And as we age, if those accounts continue to grow, then we're going to start thinking about taking money out of them for non-qualified items after age 65. And we'll treat it as a traditional IRA to make sure that that account doesn't get too large, where it creates a rather large tax problem for our heirs. And here are the key takeaways for an HSA. So again, it's triple tax advantage. You got to take advantage of it. It's probably only second to any matching contributions. Make sure you get any matching contributions first. That's where your first dollar should be. But then your second dollar should be going towards this HSA. It's portable. Its growth becomes tax-free. And there's no time limit to spend any of the funds in these accounts. And it really is ideal for long-term financial independence. All right, so here are the actions that you need to take today for the HSA. Is please review any benefits that you're open to in this open enrollment period. So make sure that if you are eligible, make sure that you read up on your plan and make sure you understand where those funds are going to go so that they make sure that you get them invested. You're going to sign up. And again, you're going to make sure that those funds get invested for long-term growth. I hope that you found this video useful. If you did, please like it and please subscribe. And if you've got any comments, please throw them down in the comment section. I'll be happy to answer any comments. And if you have any ideas for future videos, I'd be glad to listen to them. Thank you. Information provided in this video is for educational and informational purposes only and does not constitute financial, investment, tax, or legal advice. I am not your financial advisor, and you should consult with a qualified professional before making any financial decisions. All investments involve risks, including the potential loss of principal. Past performance is not indicative of future results. This video does not endorse any specific investment or strategy. By watching this video, you agree that I am not responsible for any financial outcomes based on the information provided.